welcome to Market Domination. It's 2025. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Since the election, I believe Tesla and Apple have driven more than half the Mag 7 gains and have been the key drivers of the S&P 500 gains since the election. And obviously, a lot of that, especially in the case of Tesla, is based on Elon Musk's close relationship with President Trump. And here you have a situation where the fundamental story did not play out in Q4.
The stakes are very high. If you're a strategic Republican and you're looking ahead to the future, whether it's 2026 or beyond, your time of leverage is now. What you want to extract from the speaker is now. So if they all band together and they barely squeak by and elect Johnson, that diminishes some of their leverage going forward and looking ahead at these other issues, particularly the national debt and the deficit. So to me, if you want to get a promise from Mike Johnson, you have to get it in the next 24 hours.
Basically what we saw towards the end of last year is NVIDIA stock stalled as we were approaching the launch of their Blackwell chip. So the key for the stock from here will be how well they execute on this launch. We see significant upside once the delivery numbers ramp. We think they're going to be able to exceed $200 billion in revenue just from this product launch for this year.
We got 1 hour to go until the market close. First trading session of the new year. Not a great start for the bulls, I gotta say. And it looks like we're looking at a fifth straight day of declines in terms of the trading sessions here. The Dow off 256 points, so 0.6%. The S&P 500 down a little more than 0.5%. And the Nasdaq also down 0.6%.
We start off in the green, and then we did kind of lose some steam here. Some names, I guess, that are notable we should point out, Julie, in today's trade. Tesla is
let's go to trending. We can look at some of those.
That made headlines. You saw Q4 deliveries disappointed, annual sales drop. I did see some bulls, including some friends of the show like Dan Ives or Webber's, trying to hold the line, confident that you'll see deliveries accelerate next year.
Always.
But you can see here, and we should note after what has been a tremendous gain for Tesla, of course, but off about 7% here.
Yeah, it was up about 60% last year. Yep. A lot since the election, although it's faded a bit since the election. Apple shares also weighing on things today. Some reports about price cuts out of China, maybe one of the things that's weighing on it. Also want to look at what we are seeing today in a ripple through from the oil markets, because energy is the best performing group today. And if you look at what oil prices are doing, we are seeing them trend higher here. WTI up about 2% today, about $73 a barrel. We got inventory data today, continuing to see drawdowns in inventories. How is that all feeding through to what we're seeing in stocks here? As I mentioned, energy shares in the green, but they're kind of lonely. You got utilities in the green as well because of some movement, a new contract by Constellation Energy from the U.S. government. But then on the flip side, we got consumer discretionary down, real estate, materials, tech, all of them weighing on the major averages, but it's really consumer discretionary and that fade that helped pull down stocks overall.
Let's get more on these markets, Julie, from what to expect this year. Let's welcome in now Drew Pettit, Citi U.S. equity strategist. Drew, it's always good to see you. So I saw, Drew, that you are, generally as we head into 2025 here, Drew, you're positive on U.S. equities. Your target, Drew, I think is 6,500, which I guess implies, mid-single-digit gains, Drew. So it sounds almost, you're optimistic, Drew, but would it be fair to say sort of tempered optimism here?
I think that's completely fair, Josh. And honestly, when we put the target out, we were looking at more like just kind of mid-single digits. It might be closer to 10% today with the pullback. But really the key to us was we got to work through some Q1 and potentially Q2 volatility. And then after that, honestly, the fundamental story, it's intact. That keeps us bullish. So yeah, a little bit of tempered optimism, but we like buying pullbacks because longer run, we think the fundamentals for the U.S. market are intact.
So why aren't you more bullish than Drew for next year?
It's the sentiment setup, it's the valuation starting point, and it's the comments you get about roaring kitty and duct tape banana that kind of get us worried. Like on sentiment, it's euphoric. A lot of good news is priced in. Look, it's hard to break that. We get that. We've had 5 negative days in a row now, so maybe we're making a dent at that to some extent. but we're paying a lot for good growth already. So we want to be selective on the growth side, and again, maybe find some cheaper stocks that are going to have some inflections in the year ahead.
And when you say good growth, Drew, I'm just curious, when you talk about corporate profit growth for 2025, what do you expect to see there, Drew?
Yeah, looking at about 10 to 12% for this year ahead. So I think that kind of low double digits, kind of low teens, maybe on the bullish side. Honestly, a lot of that is going to have to be driven by a lot of these growth themes and structural drivers moving us higher. And on the flip side, some of these cyclical themes in kind of the manufacturing side and inflation sensitive side of the world really haven't done anything for a couple of years now. So we need those to come back, and we need the secular stories to remain. And that's how we get 10, 12% earnings growth for the year ahead.
Drew, talk to me about the role of the Magnificent Seven in all of this. There's been this narrative that things need to broaden out. I was taking a look at the 5-year chart of the S&P 500 versus the S&P equal weight. And of course, as you know, the S&P 500 has done just fine, thank you very much, without that broadening happening really for a long time. And so what would you expect out of the Mag 7 in 2025? And, what happens if you don't get that broadening and they just do fine?
So we actually think there's not a single story for the Mag 7 anymore. We think it's more idiosyncratic. I think you guys have really touched on that today with the action. You've seen Tesla and Apple being particularly weak. NVIDIA looks a little bit better on a day like today. We think the year ahead for the Mag 7 is going to be about differentiation. They're going to be more like other stocks, not like a special cohort that just magically keeps going up and to the right.
So does that mean, we sort of made some attempts to get rid of the Mag 7 moniker this year. Does 2025 really put it to bed?
I don't know about that.
We're going to try, Drew. We're going to try.
It's pretty catchy. And I'll tell you, with the time I have with you on air today, we're not going to be able to solve this or change it. But it is funny. A lot of them do play to some of the same themes. And really the pieces of the Mag 7, like a Meta, Google, and Amazon that we still like going into the year ahead, maybe they can lift the boat of the other four, even if they get some chop.
Drew, we had some on the show who've argued to us that, listen, the most important chart for investors right now is the 10-year. With the 10-year sitting here, back at 4.571, Drew, I'm curious, where do you see that heading from here? And does that actually represent some kind of critical resistance for the stock market, Drew?
So it's funny. I'm going to pivot a little bit on this question, not intentionally, but I think it's actually a more nuanced point that we don't really talk about a lot. Yeah, level matters. 4.5 on the way to a perceived 5% will probably get markets nervous. We've been talking about that for a long time. But under the surface, what's really interesting is rate volatility. If we end up having less rate volatility this year and we end up with that range-bound 10-year, a 2-year that trends a little bit lower, that's actually really good for stocks. When interest rates aren't volatile, when currencies aren't volatile, people are willing to pay more for stocks. Just if we know what the macro backdrop is and it's going to be more solid and stable, that's a good backdrop for equities, even if rates stay, quote unquote, higher for longer.
But I guess the question is, are rates going to be less volatile this year, Drew? There's some indications that maybe that volatility is going to stick around, no?
I think that's what we're seeing in markets right now, Julie. That's a really good point. Honestly, one of our fears is we go from pricing in Fed cuts to potentially no cuts or even a hike. I think that's a bear case scenario. So why we have tempered optimism is this rate setup. We have rate volatility now. We saw that in the last Fed meeting. We've seen that in the past few weeks, and that's been equity negative. If we work past that in Q1, then I think we're probably in good shape for the rest of the year.
Drew, we almost got through this interview without mentioning Trump, and we can't have that. So Trump is moving back to the White House. That means a lot of just balls in the air here, Drew. Taxes and tariffs and regulation. Of course, we don't actually know what Trump will really do. You've seen some folks try to speculate. Well, a lot of what we've heard so far is kind of just comes down to negotiating tactics, negotiating strategy. I'm curious, Drew, as a market strategist, I know you're getting questions about this from your clients. What do you tell them?
See, this is really difficult. We don't really think it's a full market story. It ends up being very sector and stock specific. So to us right now, what we've really focused on is tariffs, because we think that's more implementable, especially in the first 100 days. And we've really tried to focus on what can get done early as a starting point. And then from there, as we get incremental news, honestly, it's, again, less of a market story, more stock specific.
And then we know that you guys have themes that you're investing around as well. If you had to pick one, because there's a lot of themes that you're looking at, but if you had to pick one that you think investors really should focus on above the others this year, what would that be?
I'm going to say fintech. So it's one of our top 10 themes. It was one of our top 10 themes last year. But what I find incredibly interesting about it is it performed really, really well in 2024, and almost no one wants to talk about it still. I think a lot of people got burned when the fintech bubble kind of popped post-pandemic, but there's a lot of stocks within this group, like a PayPal, a Fiserv, that have really good business models that are at scale that are pretty reasonably priced. So I'll give you fintech.
I'll take it. Drew, thanks so much. Happy New Year to you.
Happy New Year to you guys. Take care.
Take care. We're just getting started here on Market Domination. Coming up, Tesla shares sliding to start 2025 following a big fourth quarter delivery miss. We're going to get analyst reaction on the other side. Plus, what's the next catalyst that could drive the crypto market as Bitcoin eyes a return to 100,000? Stick around. We got much more Market Domination still to come. Tesla hit a milestone last year, but maybe not the kind it wanted to. The EV maker reported its first decline in annual deliveries in at least a decade, handing over fewer than expected vehicles in the fourth quarter. Joining us now, Jed Dorsheimer, William Blair Group Head of the Energy and Sustainability Research Sector. Jed, it's good to see you. So Tesla, disappointing most of the estimates that I've seen out there here. To what do you attribute the miss here? And do you think we can extrapolate anything overall about fundamental demand from drivers for Teslas?
Well, you were pretty much in line with the 3 and Y. Your miss came from the SX and Cybertruck. And so, that could be investor fatigue at the high. So SX and Cybertruck are all high priced. Cybertruck is going to come down in pricing. And so that may abate some of the fatigue, I guess, at that foundation model level. But it's also a very niche market. I mean, it's not going to be a mainstream pickup truck. And so, if you look back at Tesla's success, it's largely been the move or pivot from the S and X over to the 3 and Y, high volume, lower price. And so for Tesla to rebound from a volume perspective on the auto side of its business, we think it's really going to be introduction of a Model 2 or hatchback. And then, maybe down the road in terms of robotaxi. The silver lining, of course, is obviously the area we're focused on the most, which is the energy storage side, which actually is beating quite handily and also has the highest return on invested capital of the businesses.
On those relatively lower price models, Jed, what's the timeline there? When do you think those arrive, and what do you think the price point is?
I mean, the expectation is for mid 2025. Now, Tesla is notorious for being late on timelines, and Elon's thrown out a large number in terms of annual growth. And so he's really going to need to have new models in order to achieve that. And so, whether we see that, in second quarter or third quarter of this year, that's going to be really important in terms of meeting the annual growth.
Jed, do you think there's any possibility we don't get that model this year?
There's always a possibility, but I don't think, again, if we look at the miss here, you're seeing, you're missing by 20,000 units or, at that high price. And if you look at the energy side of the business, you're going to make up for that profitability right there. So, I think Tesla has a lot of different tools in its toolbox, and we'll see, how it plays out. I think longer term, they've clearly demonstrated the ability to show resilience.
Jed, how does the competitive landscape look like right now in China? I'm curious how Tesla is performing over in that market specifically.
Well, I think in the U.S., Tesla is going to, Tesla's position is only going to be stronger. I think Europe we see as the battleground. And I think in China, there's going to be vicious competition in terms of, against the likes of BYD, et cetera. But I do think that Tesla still carries a premium brand over in the Chinese market.
Jed, you mentioned you focus a lot on the energy side of the equation, the battery storage side of the equation. And as you're well aware, a lot of folks on the street, their thesis is you buy this company not for the cars, you buy it for the AI, you buy it for autonomous down the road. Do you think that the energy story is enough of a reason to, is that the story that's sort of being overlooked here that people should buy it for?
Well, I don't think that if you stripped everything else out and you looked at just the energy business alone, that it justifies the valuation of the entire company. So just to be clear, however, I do think that from a relative growth and what the energy side of the business could layer on, I feel that the street misses out on the that opportunity. And that's why we talk about that, because that could layer in a level of profitability as well as augment the revenue that could fill in a gap, say, for example, if your SX and Cybertruck are weak, like what we're seeing.
Jed, Musk likes to talk about how if you own Tesla, it's because you're as excited as he is about the future of robo-taxis. As you think about that, Jed, that future as a financial analyst, what do you think the timeline looks like for those robo-taxis, especially when you have rivals like Waymo already out there with its autonomous vehicles?
I don't think Waymo will scale. I mean, I see the approach that Tesla is taking is the one approach that actually scales. I don't have an estimate in terms of the timeline, but adding $140,000 worth of equipment to me seems like an elegant but a niche type of market. Whereas with FSD and the improvements that Tesla continues to make, that seems like a very scalable opportunity.
Jed, finally, I want to ask you about Elon Musk's relationship with President-elect Trump.
Sure.
And sort of the advantages and potential disadvantages. Obviously, there are a lot of unknowns about what the fruits of that relationship will be. But how do you think about it from a financial analysis perspective?
I mean, you may be seeing a little of that in the weak SX and Cybertruck sales. So at the high end, that might have a little bit of an impact. If you think about buying a Cybertruck, it certainly makes, in addition to everything else, you're making a statement. And maybe you are seeing a little bit of fatigue there at the high end of the market. We haven't seen the benefit side, which could be, the ability to accelerate, as we were just talking about timelines and talking about getting to autonomy. I see that as a potential beneficiary of that relationship. So, I think there's pros and cons, but I think overall, there's I'd much rather be in a position that Tesla's in here than the opposite of that. So, I see it mostly as a positive.
Right. Yes. I guess there are some perils if you were in the opposite position. Jed, thank you so much. Appreciate it.
You're welcome. Thanks for having me.
Take care. As we roll into the new year, investors are navigating a bond market with elevated yields and higher interest rates. Our next guest says it makes sense to be cautious given the uncertainty in the economic landscape. For more, we're bringing in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, it is fantastic to see you. So we were having a discussion with one of our earlier guests, and I think you're a perfect person to weigh in on this, about what is going to happen with Treasury volatility in this new year, given what looks like a higher for longer rates regime. What do you think?
Yeah, we're looking for volatility to stay elevated and maybe move higher from here. We have so many policy uncertainties on the horizon, combined with the economic uncertainties that we, typically have. Will growth hold up? Will inflation come down, et cetera? But you add in all the policy decisions that can potentially affect the growth and inflation outlook, and you have a pretty good setting for a lot of volatility in the bond market in 2025.
Kathy, I'm curious, when you look at the 10-year here, which is backed up to 4.569, some debate, Kathy, about why that is, including on this show. I know some folks say, listen, it's the economy's resilient, its inflation is sticky. Others saying, no, it's really investors telling you they're growing increasingly concerned about our country's ever more complex fiscal challenges. What do you think, Kathy? What's the reason?
Yes. All of the above are true. So, yeah, we've had a much more resilient economy than anticipated. If you think back to last September, it looked like, there was a risk of recession on the horizon, and all of a sudden we're looking at 3% plus GDP growth. So that didn't happen. Inflation has come down year-over-year basis, but it has been sticky, and particularly in things like housing, which is really critical. And now we've got some upward pressure in food prices that could add to the overall inflation picture. And then you throw in all the policy challenges that could raise inflation, such as tariffs, and or increase the deficit and over the heavy weight we have in terms of the debt. And all of that is contributing to the rise in yields. And, add in that the Fed is now looking at this and saying, well, maybe we're not going to cut rates as much as we thought because of all these factors.
Kathy, what do you think would get do you think the 10-year will go back to 5%, and what do you think would get it there?
Yeah, we think that there's a risk that that could happen. That's probably the upper end of where we see it going. But I think the factors that would do it would be that the economy stays resilient, particularly the labor market. So if that stays resilient or improves from here, that would mean the chances of Fed rate cuts are pretty slim. We have some inflation pressure stemming already from housing and a couple other places. And then what would get us there would be a combination maybe of tariffs, immigration reform that raises wages because we are missing workers, and or the prospect of tax cuts. Now, on the policy end, there's kind of a sequencing of these things over time, so it's not immediate impact. But market looks forward and says, well, if we get all this stuff, we're probably going to see higher yields from here.
So Kathy, add it up for us then. What is the strategy here for fixed income investors who are listening right now and they're looking for guidance? What is your advice, Kathy?
Yeah, the good news is that where we are now, around 4.5 or 4.6 on the 10-year, is actually, we think, fair value. It doesn't give you a lot of extra cushion for some of these risks, but given that yields have moved up 70 or 80 basis points the last couple of months, you do have some cushion now that we didn't have last fall. So we think we would be cautious on duration. So if the average sort of benchmark duration we derive from the aggregate bond index, that's around 6 years. We think keeping your average duration at that level or a little below so that you have some optionality if yields rise makes sense. We also think staying up in credit quality makes sense. We have credit spreads very, very low, very tight. And so we don't want to overdo on the credit risk side, even though the fundamentals look good, especially for investment grade. So we're saying that up in credit quality, a little below benchmark in duration, and then just riding it out and looking for opportunity when the market, exceeds its at what we think is a reasonable level. And so in that way, it's not a bad setting for investors. You get some yield while you wait, and you have opportunities, I think, due to the volatility coming down the road.
And do you think that within those parameters, the sort of 60-40 stocks, bonds still make sense this year?
Well, we still think some allocation to fixed income and equities makes sense. Everybody's going to mix is going to be a little bit different based on their situation. I think 60-40 is not a bad place to start for a lot of investors, particularly if you're moving into retirement or in retirement. I don't think it's going to be a bad year for 60-40 because, at least from the fixed income side, you can sort of project forward what your total return is going to be using the coupon. And right now, coupons are between 4 and 5% for most fixed income investments, maybe a little higher in some situations. So you can look at mid-single digit returns as a likely outcome when you look forward for the year.
Kathy, great to see you. Thanks for joining us.
Thank you.
All right, let's get to some trending tickers. First up is Lyft. That stock moving higher today. It's after a new article in The Information predicted the ride-sharing company could be acquired by Amazon in 2025. The article citing Lyft's network of 24 million active riders as a way Amazon could commercialize its own line of Zoox autonomous vehicles. Lyft and Amazon previously partnered, remember, on package and grocery deliveries during the pandemic in 2020. So this is from The Information, Julie. To be clear for viewers, this is a prediction, right? But it's fun, it's interesting. Why would Amazon buy Lyft? They say, well, what would Amazon sort of get out of it? They talk about the size of that existing ride-hailing network. That could be key to helping Amazon commercialize its autonomous vehicles. Back in, I believe it was 2020, Amazon, remember, bought its own autonomous driving startup Zoox, which has been testing. So maybe that's a way to supercharge that, is the theory.
That's the theory, but it's also sort of like, wouldn't this be fun if it happened? But maybe it speaks to some of the depression felt by Lyft investors, that they are jumping at something that is basically just like, oh, wouldn't this be cool if this happened? The shares were down last year of Lyft about 14%. So coming off of those depressed levels and looking to get into 2025 maybe with a little bit of a boost to start.
Yeah, the information did remind me, I'd forgotten, that Lyft CEO David Risher was one of Jeff Bezos' earliest employees. I had forgotten that. Now, Risher has talked about his strategy has been sort of like in the autonomous vehicle market, it's been, okay, he's going to position Lyft as sort of a partner for different platforms.
Right.
His belief being there won't be one winner, there'll be multiple, and he sort of talked about he obviously thinks Lyft could be one of them.
Well, Uber's kind of tried to do that too, right? Offering Waymo on via Uber, but Lyft hasn't gotten there yet, right? So they both are partnering in their own ways. It's just that Lyft hasn't gotten that partnership yet that I'm aware
days.
of. Yes,
Early days.
exactly. Car rental app Turo is making headlines today, but not for reasons perhaps that it would like. Joining us now with more Yahoo Finance's Pras Subramanian, and this has to do with the New Year's attacks that we've been talking about and watching.
Right, Turo in the spotlight here, and not the best light, obviously. And there's a lot of questions as to what is Turo? How did this happen? What exactly is the service? So just sort of explaining that what this is basically a peer-to-peer rental service, or the Airbnb of cars. So let's say you have a car that you use from time to time and you want to make some money off it, you can rent it on Turo. Anyone can do this. You sign up as a host and users sign up. And the thing that's appealing to Turo is that it's very easy. You get to be 18 years or older, a license and a permanent home address, and that's basically it. And the company says that they do a background check, but not always does that entail criminal and credit checks and things like that. And that potentially is a potential flag for the business, right? Is that the user is not fully vetted. Car rental firms also don't necessarily do this all the time either. Right. But at the same time, at least with the car rental firm, you actually have to go to an actual physical location. You talk to a person, you rent the car there. There's actually an exchange of the keys and the documents and the car handoff. Whereas Turo, in some instances, can be totally self-check-in. There's no person that actually checks you, and you just pay for the car, sign up for it, and you just go to a spot, and there it is. So there's some issues. Or the FTC has warned in a couple years ago that it's rife with fraud potentially. People use cars for crimes and other joyrides, and people that are actually hosts should be careful. So that's one aspect, and I think that's what people are looking into right now is, was there the proper vetting of these individuals renting on Turo? I think that's the big question. And this company, as you know, filed for an IPO a couple of years ago. That's been delayed. The company's profitable, but those profits have been coming down in recent times. They filed an updated S1 in the fall. And the question is, are they doing enough, or spending enough to vet their users?
Is this the first time, Pras, that we know that the Turo app has made headlines for this, like been involved in crimes?
There's data out there that says that something like 5% of all car rammings are using car rental, like regular car rentals. And there's also been some anecdotal data about people using peer-to-peer sites to rent cars for crimes, and maybe bashing into a store, taking stuff, and all kinds of things where you don't just need the car for a limited amount of time. So there is some anecdotal data of that happening already. The question is, we don't have enough to see a trend.
Interesting.
All right, Pras, thank you. Appreciate it. Coming up, Bitcoin taking a breather to start 2025. So what's the next catalyst that can push the token over that 100,000 hump for good? We're going to speak to a strategist on the other side. Stick around, more market domination still to come. Bitcoin has taken a breather to start 2025 after hitting 100,000 toward the end of 2024. Still, despite the recent dip, 2025 expected to be a big year for crypto. And joining us now is Ben McMillan, IDX Advisors Chief Investment Officer. Ben, great to see you. So let's talk Bitcoin, Ben, because we were at around 108,000. Now we kind of fizzled here back to 97. I'm curious, Ben, what you make of that drop. I heard some speculating that, maybe this is folks saying, hey, that was quite the run in 2024. I'm going to book some profit here until I see what Trump is actually going to do. But I'm curious, what do you make of the action we're seeing?
I think that's definitely part of it. Again, when you look at the kind of, in the context of Bitcoin price moves, it's not even all that big of a pullback. I think absolutely there was some profit taking, especially across, if you look at the adoption that we saw recently in the Bitcoin space, you had a lot of people, come into the asset class by ETFs and whatnot, relatively, mid or late in the year. All of a sudden there was this huge run up. So instinctively going into year end, you're going to see some, profit taking. I also think, to your point, there was a lot of, or not a lot, but there was some uncertainty about the regulatory outlook. And that's one of the big bull catalysts we see going forward is now, a massively improved regulatory framework for crypto innovation. And I think that's going to be the real catalyst for 2025 and onwards that kicks Bitcoin into, a higher price tier kind of permanently.
So I guess what specifically then would be the catalyst, Ben? Would it be the announcement of that framework? And that obviously, or I don't know, maybe it's not obvious. I don't think that's going to come on January 20th, right? If there is indeed going to be this new digital asset framework that comes out, one would imagine it's going to take a while for that to come out.
Yeah, and I think it's not so much what the government's going to do. I think it's more what they're not going to do. So the one clear signal that we got through this election season was that, the Trump White House coming in, whether or not they do things like a Bitcoin reserve or not, I think that's secondary to the fact that we're going to have an SEC now, we're going to have a Congress now that is not nearly as antagonistic towards Bitcoin, as it was historically. If you look at, for example, the Bitcoin lobbying effort, I mean, they were hugely successful in terms of putting in congressional members on both sides of the aisle that were favorable to Bitcoin. And so when you start looking at, go back to DeFi summer, kind of 2021, when we first saw the kind of Web3, Web3 outlook, the DeFi outlook, all this promise of use cases that would, pivot Bitcoin from being just this kind of interesting, digital project into something more mainstream. Now you layer in generative AI, which I think is a really interesting intersection for Bitcoin. I think that's going to be what actually catalyzes it for mass adoption, outside of just kind of the traditional store of value folks, as well as the, the hobbyists. And now, you look at Coinbase as a perfect example of a company that's been kind of on the cutting edge of innovation, and they've been, sued by the SEC for any number of things. With those roadblocks removed, it's kind of clear skies ahead for a lot of innovation in the private sector to bring, in particular, I think, generative AI into the crypto world. And that's going to be what really makes it easy to adopt for everybody.
It's interesting, Ben. Why do people own Bitcoin? When you explain that to your friends and family, it's referred to, even here on Yahoo Finance, you'll see it's referred to as a cryptocurrency, but it's not a currency, Ben. So do you own it for the trade? Do you own it for the portfolio diversification? What's the role it plays?
Yeah, it's interesting. So, we've been early in the space as it relates to kind of dealing with customers and Bitcoin allocations, going back to 2019. And so what's interesting about that is we've heard, a lot of different kind of takes on Bitcoin. At first it was, digital store of value, then it kind of moved it, people looked at its correlation to risk assets, which increased post 2020. And we think that's here to stay. They started saying, all right, it's trading more like a high beta tech stock. Is it an inflation hedge? Well, not one-to-one, if you look at a correlation analysis, but over longer terms, it's, it's definitely kind of that store of value as it relates to, fiat instability. So I think it's a combination of everything. I think it's interesting when you look at some of the big buys recently. I wouldn't be surprised if you start to see more central banks, not necessarily in developed markets, but in the developing markets, start to actually aggressively adopt Bitcoin is part of their treasury. There is a technology component. Anytime somebody says, it doesn't do anything, it's a Ponzi scheme, you don't have to point too far to show real world use cases. And like I said, I think that's only going to increase as we start seeing, more innovation in the space, again, particularly as it relates to the intersection of AI. But it's its own asset class, and to some people it's a pure store of value, to some people it's a long-term inflation hedge, to other people it's a speculative bet on all this technology that I talked about.
And Ben, obviously most of the discussion centers around Bitcoin, but there's a whole universe out there, right? So as you go into this year, how are you allocating, or how are you recommending that clients allocate to crypto? Is it mostly in Bitcoin, or are you telling them to also buy other stuff?
So the first thing we always tell clients is it's highly individual to their risk tolerance. Before we talk about anything as it relates to, expected returns, the first thing we say is there's three certainties in life: death, taxes, and another major drawdown in Bitcoin is right around the corner. So with that said, to the extent that you have clients that, Bitcoin is, the biggest, it's the most liquid, it's kind of the easiest for people to wrap their head around. Ethereum, of course, is the close number two. So when you get out of Bitcoin into this, the kind of the second order coins or cryptocurrencies, there's a lot of really interesting things going on. Ethereum is one to keep an eye on. It's had a lot of competition recently from the likes of Solana, which I wouldn't be surprised if we see a Solana ETF in the back part of this year or 2026. There's a lot, and again, this is where a lot of the innovation is happening, and this is where you're seeing a lot of the real world use cases play out. So there's some very interesting protocols. It's evolving very rapidly. The AI space is an interesting one. Like I said, virtuals is the kind of the hot new thing. Yes, there's a lot of hype around it, but again, like any transformative technology, there's some really interesting use cases there. So to answer your point, directly, we're generally big fans. If people are going to hold more than Bitcoin, we generally always tell people to kind of diversify, prioritize liquidity, prioritize use case. You want some, stay away from meme coins. Look for something where there's an actual use case, a protocol that's, providing some value, some utility to the broader ecosystem, and keep an eye on what's coming to market, because there's a lot of exciting projects out there.
Ben, good to see you and have you on the show. Thank you for joining us.
Thank you.
All right, now let's get to some calls of the day. Goldman Sachs coming out with a new note on the cybersecurity sector. The note includes giving Cloudflare a double upgrade. So, Julie, that's it. Goldman with a rare double upgrade goes to buy on Cloudflare from sell. Price target is 140. They talk to their clients about two catalysts for the stock in 2025. One, they talk about an improving sales and marketing productivity cycle after 2 years, they say, of evolution to better address platform sales. And it looks like they see opportunity here when it comes to AI inferencing use cases. They are buyers.
Yeah, and they talk a lot about, too, in the broader cybersecurity context, that the conversation has really shifted to a platform for cybersecurity rather than a point of contact or a particular product. And they talk about Cloudflare being one of the success stories on that front. That said, part of this feels like a mea culpa, even though they don't really say it that way. But they do point out in the note, since they added this stock to their sell list on February 14, 2023, the stock is up 59%. It's underperformed the Nasdaq, but it's outperformed the S&P 500, and it's outperformed their cybersecurity peers. So if you slap a sell on something and it keeps going up, maybe eventually you're going to say, well, maybe you should buy it now. But they also talk about the fundamentals having improved as well.
They also did downgrade Checkpoint software, by the way. They go from buy to neutral on Checkpoint software. They say 2025 is a year of incremental investment as its new CEO assesses priorities for growth. Target there looks like 207.
Gotcha. All right, and then we've got KBW downgrading SoFi to underperform. That note citing long-term upside still being years away. SoFi shares have done well. They did well last year. They're down about 8% today. And the note talks about that investors have been very optimistic about fintechs like SoFi, which was kind of one of the first movers in the so-called neobanks space here. But basically, KBW is not buying it here, that they say the return on tangible common equity is just not up to par in what it should be in this company's valuation.
Yeah, they say the path to long-term guidance appears long and difficult. Stock has enjoyed a great run. It's up about 50% over the last 12 months. KBW saying in part that's investors optimistic about high growth fintech following the election, improving macro, lower rates, but now at least KBW is saying this one is just too rich.
Yes.
All right, Jefferies upgrading Top Golf Callaway brands to a buy. It's back to basics, according to that analyst note, saying it looks oversold at a time when golf market is supported by robust tailwinds. With this company set to split, they talk about, Julie, some of the parts valuation, only 2 times current share price. There seems to be strong value.
Yeah, and they're doing this analysis of this company pre-split into back into Callaway and Topgolf, and comparing it to Acushnet. Ticker on that one is Golf, and saying that if you look at their sum of the parts analysis of these 2 parts of the business, that it's trading at a discount to Golf, to Acushnet, and they think it should not be, given the fundamentals of the stock. So the price target on that is what, $13, and you can see here it's trading at $8.91.
By the way, I am not a golfer, but for golfers who are watching right now, the analyst also talking about, and this is one of his reasons for optimism, golf is on track for a record year. He says in October, golf rounds nationwide saw their largest year-over-year increase since 2020.
Really?
With 2 months left to track in 2024, they were talking about year-to-date play ahead of 2023's pace, which had already set a record in the U.S.
It's not too late for us to pick it up.
So a lot of golfers.
It is
we're
too
missing
late.
out.
No, we're not missing out. All right, coming up, we're counting down to the closing bell. Stocks are lower to start the new year. Stick around, much more market domination still to come.
Apple agreeing to pay $95 million in order to settle a privacy lawsuit with users whose conversations were accidentally captured by Siri. This comes after iPhone owners complained the company routinely recorded their private conversations after they activated Siri unintentionally and disclosed these conversations to third parties. According to Bloomberg, the proposal still requires approval by a judge, and Apple has denied any wrongdoing, but U.S.-based Apple product owners could get up to $20 per device, and it would apply to a subset of U.S.-based people who owned or bought a Siri-enabled iPhone, iPad, Apple Watch, MacBook, iMac, HomePod, iPod Touch, or Apple TV between September 17th, 2014 and December 31st of last year.
Well, global insurance premiums fell in 2024. That's the first time that's happened since 2017, as the market became more competitive after years of rate rises. With more rate cuts a possibility and a government unified under Republican control, how is 2025 shaping up for the insurance industry? Joining us now, Joshua Shanker, BofA Securities Senior Insurance Analyst. Josh, so as we look at the insurance industry, we have talked a lot on the show about, yes, there have been rate cuts, but the idea is that now we could potentially see higher rates for longer. We've talked a lot here about how that's affecting the banking industry, less so insurance. So tell us about the impact on that industry.
Well, in theory, interest rates should be positive for the industry as a whole. They can make money two ways. They can make money by underwriting, and they can make money through the investing. In theory, though, over time, if you're making more money on the investing through higher rates, there might be relief on pricing in order to take advantage of those higher yields. So for like in the 1950s, you made a lot of money on the underwriting because interest rates were low, and over the next 50, 60 years, you made less on the interest rates and more on the interest rates and less on the underwriting. Of course, the last 10 years, interest rates have been low, so the cost of insurance has gone up to compensate. So in theory, and it's been a long time, there could be some rate relief over the long term in terms of what insurers charge on the grounds that maybe they couldn't make more on the investment income. But that remains to be seen. It's been a long time since companies have been willing to do what we call cash flow underwrite, just to borrow the float in order to cover their costs.
Josh, I'm curious, as we head into 2025, broadly for your coverage universe, insurance stocks, how does valuation look here?
Well, it depends. I mean, look, insurance as a subsection of the economy, it's cheap. An S&P 500 trading 20 times earnings. You look at the multiples on insurance stocks in the low double digits, they look a whole lot cheaper. And that naturally attracts value investors who are looking to get into a sector at a discounted price. The most vibrant stock in the space is probably Progressive, which trades at about a market multiple, and we actually think it's attractive. So I don't know if valuation is always the best indicator, but as a sector broadly, insurance stocks seem cheap relative to the market, although they've been cheaper than the market for a long, long time. They have less growth, and therefore, the multiples are not as high. Ultimately, though, there's opportunities in the space, and we think that there's opportunities for investors to find some cheap stocks whose multiples are low but do have actually real growth potential.
And would Progressive fall into that category or not, since it's sort of priced at the higher end of that? And what makes it sort of the more vibrant than its peers?
Well, first of all, although Progressive on a PE multiple seems rather expensive, our outlook is over 30% above street consensus numbers. On our numbers, it doesn't look all that expensive. We're pretty much an outlier in the space. There's not that many sell-side analysts who have a recommendation on a stock that's 30% above the street in terms of where EPS is. And we're fairly confident in our outlook. And it's been underestimated for a very, very long time. And part of the reason, I sometimes call it the Amazonification of the shopping experience, Progressive is selling insurance the way people want to buy it, direct, disintermediating the agent in the middle who's usually collecting about 15%. So for an individual who thinks, look, I'd like to save money on auto insurance, when you hear the Gecko say you could give us 15 minutes and you could save 15% more on auto insurance, it's true because it's disintermediating a cost in the middle, which is the distribution. Progressive has been better at this than Geico, even though Geico had the tagline. And we think over time, they will continue to persuade people to shop directly for insurance instead of shopping through an intermediary, and that will continue to fuel the growth.
What about, Josh, Corebridge Financial? Why is that a buy? It's had already a nice run. It's up about 40% here over the past 12 months.
Well, Corebridge is a unique story. It's the life insurance businesses, particularly U.S. life insurance businesses of AIG. And AIG and Corebridge are separating from each other through the sale of the life stock into the public domain. And with the sale of Corebridge, we think there's a lot of investors say, well, I'm going to wait around a little bit. I know that AIG is going to be selling more. It's our anticipation that's probably another offering is out there, and then Corebridge will be free of that ownership. But arguably, part of the reason why Corebridge trades where it does, even though it's been a very successful stock, it still is quite cheap on a PE multiple. And part of the reason is that overhang of the potential for another sale to come. But the movement also tells us in the stock that the investors may not actually care about the potential for sale and find it attractive already. With higher interest rates, again, you talk about what effect that will have. Generally speaking, for life insurance stocks, for annuity stocks, where the 10-year trades is of key importance to where the stocks will perform, and where I think that over time operations will be successful for life insurance company. The whole sector seems undervalued, but Corebridge particularly so, especially as it gets on its own 2 feet as a separate business from AIG entirely.
And then, Josh, finally, to broaden it back out, as we look at the outlook for property and casualty rates specifically going into 2025, do you think they'll be going up, or what do you think will be the direction?
That's a broad subject. So I think the people look most, because it affects their pockets, auto insurance. And my expectation is, with all this talk about inflation, people want prices to go down. Prices almost never go down for anything. And what we'll see is price moderation. My expectation on the auto insurance front is flattish pricing through 2025. That's not going to feel great. It's still going to feel expensive, but that's better than pricing being up 15-20% as it's been for the last couple of years. On January 1st, yesterday, 60% of reinsurance contracts renew. Generally, pricing was down about 8%. That's some relief, and that will ripple through the whole market and probably give some relief to property pricing overall insurance markets. But in general, for commercial insurance, which is a bunch of different lines of business, I don't think we should ever expect rates to go negative. But there will be a mix of things, and probably low single digits for commercial insurance broadly is probably a reasonable outlook for 2025.
Josh, appreciate your time in those stock picks. Thanks for joining us.
Thank you. Take care.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
There's the closing bell on Wall Street, and now it's market domination overtime. Let's take a check on where the major averages ended this session. Fifth straight day down for the major averages. The Dow off by about 150 points. That's about a third of 1%, a little bit up off the lows of the session. The S&P 500 down about a quarter of 1% here. And, we always talk about the so-called Santa Claus rally. It happens on the last 5 sessions of the year and the first 2 of the new year. So after tomorrow, it will officially be the Santa Claus period. And obviously we have not gotten the rally that a lot of folks were hoping for. And then finally, the Nasdaq as well, down again on the day, almost 0.2%. So seeing consumer discretionary drag things down today. Specifically, we've been watching Tesla very closely today after that company's deliveries missed estimates, and it showed the first annual decline in deliveries in at least a decade. The shares down 6%. Just wanted to give a little perspective on what we have seen for these Tesla shares. Here's the one-year chart of Tesla. And obviously, you got a big surge even going into the election, but then post-election. So the shares are now up around 30% since the election, but they've also come down 20% from the highs where they were in mid-December as we continue to watch the stock and where it is going to be headed this year. Apple shares down today as well. That's the one-year chart, but if you look at today, off almost 3%. NVIDIA up today. Maybe this speaking to something that Drew Pettit of Citi talked to us about earlier in the show, which is sort of a further differentiation within the so-called monolith that is Mag 7, right? Seeing these stocks really start to diverge a little bit more than they had been. Something else that I've been watching closely today, and I've been watching really over the past year, is what's going on in the power industry, the utility industry. And if you look at these stocks in today's session, Constellation Energy helping lead the gains after it signed a couple of contracts with the federal government to provide nuclear power here. The shares up 8% on an intraday basis. And if you look at the 1 year, of course, we've seen very strong performance, nearly doubling. But there's one stock that also has outpaced Constellation over the past year, and that stock is Vistra, which actually was the best performer last year in the S&P 500. It is relatively unusual to have the best performer from the prior year continue that rise on the first day of the new year. You usually get a little bit of rotation, but that's indeed what we saw on that Constellation news. Vista closing higher by 8.5%, Josh.
All right, Julie. The benchmark 10-year yield rate rose slightly to start the year, remaining near its highest level since late May. And our next guest says we could see investors begin to shift out of bonds and into stocks. For more, let's welcome in now Clark Gernon, Calbay Investments Chief Market Strategist. We lost him, Julie, for a bit. I'm sure they're working hard right now in the control room to reconnect. The question I was going to ask Clark, which we hope to have back soon, was with the 10-year here at 4.563, where we head from here. I thought it was interesting. We spoke to a fixed income guru today on the show who thought it was likely we actually head on right back up to 5. And the question would become then, okay, what kind of challenge would that pose to the equity market?
Right, and it is so interesting, right, that even with that outlook for rates to continue to go higher, with rate volatility to potentially stick around, that we still do have a good amount of optimism on the stock market, right? That rates getting up to that level, there's a new perception the rates are going to be higher for longer, has not put that much of a dent in either earnings expectations for this year or returns for the full year. I think the median estimate from the strategist is something like 6,600 for the S&P 500, which, you know, it's not huge gains, but still third straight year of gains potentially for stocks.
When we talked to Kathy Jones at Schwab on the show today, I thought it was interesting too. I asked Kathy what explained the backup in the 10-year, because there was some real debate on that you would hear about whether that's an economy that's resilient, that's inflation is sticky, that's folks telling you I'm getting worried about the fiscal challenges. And what did Kathy say?
Yes.
Yes.
All of the above. All of people having a lot of different reasons for what they've been doing in the bond market.
That's
yes,
it.
I like that answer. Coming up, will a vote of confidence from President-elect Donald Trump give Mike Johnson the boost to remain Speaker of the House? We'll discuss when Market Domination Overtime returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Mike Johnson was hoping a vote of confidence from President-elect Donald Trump would give him the boost needed to remain Speaker of the House. But it's anyone's guess how Friday's vote is going to go, since just 2 GOP defectors could block Johnson from the job. Joining us now, Yahoo Finance's Ben Worschel. So, Ben, what's going to happen to Johnson, and why is this being so closely watched? What are we learning from all of this?
One of the only things we know right now is that Johnson's got a kind of long day ahead of him. The vote's at about 12 noon tomorrow, and the situation, as you mentioned, is he can only lose 1, maybe 2 Republicans in his caucus can vote against him, and he can still become Speaker. So he basically needs unanimity. Trump's endorsement did change things a bit. It moved some undecideds into his camp, but right now he's got one. Thomas Massie of Kentucky, who's a definite no on Mike Johnson. And we've got about a dozen House Republicans who are kind of undecided at the moment. And what we've seen about in the last hour is a whole bunch of this group go into the Speaker's office on Capitol Hill for a meeting. It's a meeting that it appears to still be going on now. And there's clearly going to be a lot of back and forth there right now. What this group wants are concessions for how the Congress will operate in the year ahead, which will matter for a whole lot of these issues, rule changes, key committee assignments, things like that they're going for. The question is whether Johnson can do it, whether he's willing or able to make these concessions to get basically everyone on board. And we won't know that until tomorrow about noon when they start.
Ben, another piece of Congress's business, the debt ceiling, already making Donald Trump antsy. What can you tell us about that?
Yeah, so this is one of a whole host of issues that the speaker's race this week will impact. You know, there's the debt ceiling, there's energy, there's border security. The debt ceiling is the one that obviously the markets are watching closely, and it seems to have really gotten the most under Trump's skin because it's been something he has made very clear on since winning the election. He wants the debt ceiling off the table. He doesn't want to have to deal with it. He tried to get it off the table in December. Even last week, he had another post to say it needs to be done before he takes office. He has been sort of roundly ignored on that, and it's clearly going to be an issue that he's going to face all the way through the spring. What we do know at the moment is that it's beginning. The debt ceiling was formally put on today. Treasury Secretary Yellen says that what are called extraordinary measures start in about 2 weeks' time, and then it's anyone's guess as to when it goes. One analysis says mid-June is when the final deadline will be, which would be an actual government default. But that'll be a moving target. And so Mike Johnson, as one of the million issues he's dealing with this week, is sort of how does he fit that into everything he wants to do in the next few weeks? He said he wants to make it a reconciliation bill and have a lot of cuts with that. That's a lot easier said than done because it requires getting a consensus. And if you can't get the consensus to be speaker, this is going to be even a harder lift for him for sure.
Yeah, so not only a long day for him, but a long week or weeks
long year,
as well. Long year. Thanks, Ben. Appreciate it.
Thanks much. Have a good day.
Companies across the country are preparing for President-elect Donald Trump's second term in office, and those that once distanced themselves from Trump are now donating to his inauguration fund. For more, we're bringing in Gautam Mukunda, Yale School of Management Executive Fellow and author of Picking Presidents. Gautam, it's good to see you. So how the tone in Trump 2.0, as many are calling it, is so dramatically different from the corporate world. To what do you attribute that? Is it pragmatism on the part of these folks?
It's definitely pragmatism, but it's pragmatism of the most barefaced sort. So essentially, they have a problem. The president of the United States, the most powerful person in the world, has shown that he's willing to use the power of the federal government to punish anyone who he views as a political enemy or even not sufficiently supportive of him. And that's not, it's not a theoretical concern. It's something that he's said he wants to do, and it's something that he did in the past. In his first term, remember, he launched massive attacks on Amazon because he felt that Jeff Bezos, through his ownership of the Washington Post, was his opponent. And that involved both, trying to get the Postal Service to charge Amazon more money and challenges to a major contract between Amazon and the Department of Defense. So companies are seeing this, and essentially they're being told, great company you have here, it would be a shame if something happened to it. They know how to interpret that message, and they are interpreting it in the way that Trump wants them to.
Do you think, Gautam, it could have anything to do also with the fact that this election, different than 2016, and it was a decisive win for Trump? Unlike 2016, he wins the electoral vote, he wins the popular vote. There's a certain decisiveness there we didn't see in 2016. Could that help explain some of this?
So I think what it explains is that the level of intensity of the opposition is a lot lower. You don't see the massive marches of the organization for it. You just see on the left a kind of, despair is almost not too strong a word. There's an apathy, a sense of whatever happens is going to happen. And so what it means is 8 years ago, companies that did this sort of thing would have faced huge pushback from Democrats, from activists, from their own employees. This time around, it's basically cost-free. $1 million doesn't mean anything to Amazon or to Jeff Bezos, but it might buy them some regulatory forbearance from someone who, remember, Trump went into this campaign proclaiming his intent to ban TikTok, met with a major shareholder of TikTok, and came out of that meeting, who essentially promised him large campaign donations, and came out of that meeting and said he now opposed the banning of TikTok. Trump is very transactional, and these companies are entering into a transaction.
So are there any perils of this strategy?
Oh my goodness, yes. Rudyard Kipling, perhaps non-surprisingly, said it best. He said that once you have paid the Dane Geld, you never get rid of the Dane. When you have said, I will pay up if you threaten me, the incentive that you have created is to keep threatening you in order to get more payouts. That is exactly what these companies, I fear, will learn the hard way. That if you've shown that you will knuckle under, you don't incentivize the government to ignore you. you incentivize Trump to come after you instead of going after harder targets who might stand up to him. Mike Bloomberg is not going to donate to the Trump campaign. And I kind of think that means that Bloomberg will be the last target, not the first target, because he knows that Bloomberg will fight back.
Do you think, Gautam, there are certain American executives who have a finer line to walk here than others? Like I think of those big American tech CEOs, right? And I fully understand why a parade of them reportedly have been going over there to Mar-a-Lago with chief executives of Meta, Amazon, Google, right? I mean, if you're a tech CEO, you would like to be telling Trump what you think about AI and tariffs and immigration. At the same time, if you're an American tech CEO, you know your employees, tens of thousands of them, back in the Bay Area, they don't like Trump. I mean, is there a finer line? Is it a tougher balancing act for some execs to walk than others?
I don't envy them this decision, because tech CEOs have, and all CEOs at this point have profoundly conflicting interests. They have legitimate interest towards their shareholders and their stakeholders and their employees. That means that they have to pursue the interests of their company, even if that means doing things they might not want to do, like, paying blackmail, essentially. And the flip side, of course, is that they have these tensions, both their duties to their fear for their employees, but also their duties as Americans to not engage in this act in these sort of actions if they don't believe in it. And that's a pretty profound tension that they're having to grapple with. Of course, they're going to have to walk a fine line. What I suspect is that what they're going to find out is they don't know where the line is, and that will be the danger. Because right now, as you commented, as like the pushback on Trump is not there. But in tech world, if Trump were to go with the more radical activists in the MAGA base and sort of start banning H-1Bs or pushing Indian high tech workers out of the United States, there are a lot of people in Silicon Valley who would push back really, really hard against that. And CEOs who thought they were playing it safe by donating to Trump might find out that essentially their previous actions are viewed in a very, very different light if the administration acts in the ways that their employees most hate.
Well, and Gautam, you've sort of talked around this, but the idea that the last time around, some of the reasons that CEOs were speaking out against things like January 6th, for example, was both because maybe they felt it was the right thing to do, but also because there was a groundswell of noise from their employees and their customers. Where did all of that go? Is it still there and they're not paying attention to it, or is it just not there anymore?
So it's kind of striking, in fact, that many of the companies that issued statements condemning January 6th seem to have mysteriously deleted them from their web pages. So that tells you where they're going with this. I would say right now it's not there. The Republican Party controls the House, the Senate, the Supreme Court, the presidency. Their liberal opposition to Trump has not yet coalesced. It may. I would be frankly surprised if 2 years from now we didn't see massive Democratic opposition to Trump, just because that's how these things work. And given that the Republicans are operating with a 2 to 3 seat margin in the House of Representatives, this is not going to be an easy 2 years for them, and they're probably going to lose the House in 2026. So yeah, that pushback is going to happen. The odds are, but it hasn't happened yet. And if you were a CEO choosing between the virtual certainty of attacks from the President of the United States or the possibility that in the future you might be getting pushback from, after all, the people who just lost the 2024 election pretty badly, I think you might decide to bend the knee to the president instead.
Gautam, always good to see you and have you on the show. Thanks for joining us.
Always glad to be here.
The benchmark 10-year yield rate rose slightly to start the year, remaining near its highest level since late May. And our next guest says we could see investors begin to shift out of bonds and into stocks. For more, let's welcome in Clark Garanon, Calbay Investments Chief Market Strategist. Clark, it's good to see you. Let's start there with the 10-year, Clark. And we're here at 4, 5, 6. We were talking to a fixed income strategist, Clark, earlier in the show, Kathy Jones from Schwab. Kathy thought, listen, it's likely the 10-year actually makes its move back up to 5%, Clark. I'm curious, do you see that as the likely possibility? If that did happen, Clark, what would that mean for the equities market?
So we're thinking that we'll see the 10-year move up to roughly 4.75. Not sure if it's going to make it all the way up to 5. Over the past few months and over the past year, as we saw The Fed cut interest rates by 100 basis points. We also saw the 10-year yield tick up 100 basis points. So it is something that we're watching, but we think that it'll stay around the 4.5 to 4.75 over the next year. But seeing that now the yield curve has normalized, we have the 1 month below the 2-year and the 2-year below the 10-year. We've seen that spread between the 2-year and 10-year double over the past month. So for us, that's a positive sign. And there's so many tailwinds moving into this year that we have a more positive outlook on 2025 than we did of 2024.
So walk us through that a little bit. So it's a sign that investors are not as worried about a recession, for example. It also makes it less attractive for folks to hold shorter term debt. You know, we saw that huge boom in things like CDs, right, with rates rising. Where does that money go? Do you think it will come out of those shorter term instruments? And where do you think it goes?
That money will come out of the short term and head into equities. And we've already seen that. So over the past year, a lot of investors have put their money into the short-term yields because it's a great safe haven. The risk-free rate has been roughly about 5% last year. But we're seeing investors move that into equities. And from our stance, over the next 3 to 6 months, we're planning on putting that cash to work. So as we find out more about the tariff policy and fiscal policy of the Trump administration next month, we think that with any turbulence, we're going to be putting that cash to work. So a couple of weeks ago, we saw the VIX jump 75%. So clearly, investors are feeling a sense of nervousness. And I think a lot of that has to do with the last rate cut and moving into January with the new administration. But we still think that over 2025, we're going to see double-digit returns. And although we've seen more than 20% returns in the past 2 years, if we look for the 3-year span, really we're looking at an average of 9% annualized. So we still think that there's a lot of room to run in 2025.
And in 2025, Clark, under the hood in terms of sectors, where in your opinion do I want to be positioned? Where do I want to be overweight?
So with the deregulation and corporate tax rate cuts, we still see financials as performing well in 2025. Clearly, they did great this year, over 30%. So we're seeing that as one of our top spots. Healthcare, although it got banged up this year, we do believe that 2025, they're going to have double-digit returns in the healthcare sector. And that's just from a myriad of things. Like I said, some deregulation, as well as advancements in AI and continued GLP-1 use.
What happens with technology going forward this year, do you think?
So we obviously saw the behemoth of the Mag 7 outperform this year. It drove over half of the total S&P return. Not that we are underweight Mag 7, but we did perform a rebalance at the end of the year. I think a lot of investors were looking at a rebalance towards the beginning of this year once we knew more about the Trump administration. But that being said, we did make that change now. So we did a rebalance. And I think naturally after seeing the positive 2 years, a lot of that money comes from some of the large cap growth. And we're going to be diversifying back over into some of the value. You know, we have seen valuations stretched. And I think most people, as they perform just a normal rebalance, are going to be taking some chips off the table and moving some of that into value.
Clark,
from our perspective,
I'm sorry, go ahead,
doesn't
Clark.
mean that the Mag 7 is going to underperform.
Clark, final question. I'm just curious. Overseas, Mark, Clark, when you look internationally, are there major markets where you see opportunity?
So no. Typically, we like to keep under 10% in non-US stocks. And I think China is going to have a difficult run moving into next year. Hopefully, tariffs are just used as a bargaining tool. We'll know full scope maybe next month, 2 months. But there are some bright spots in Japan and India. But across Europe, we are also going to be underweight there, as we just saw the Mag 7 last year pass the full value of the stock 600, which is incredible, roughly 16 trillion to 13 trillion.
Clark, thanks very much. Appreciate it.
Thank you.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Weakness on Wall Street. It looks like we'll be missing out on a Santa Claus rally as the S&P 500 extends its losing streak to 5 straight sessions now, and it was a volatile day for the market. We're diving into the themes of the day. Plus, one of the top trades of 2024, almost anything related to artificial intelligence. But the question, of course, for 2025 is whether there is still more opportunity ahead. We have a look at what you need to watch in 2025. And some of the biggest banks backtracking on sustainability efforts, what it says about the political backdrop ahead. Well, the big question around the AI trade in 2025 is whether the momentum from 2024 can last. And my next guest says there's still more room to run. Joining me now is Ben Beharin, Creative Strategy CEO and Principal Analyst. Ben, it is always great to see you and have you on the show. So we'll call this, Ben, Ben's big tech predictions for 2025. And we'll start here, Ben. You know, obviously in 2024, that mega AI trade and trend, there was nothing investors were more excited about, Ben, more interested in They found different ways to play that. Obviously, the Mag 7 tech stocks, that was one way to play it. I'm curious now, Ben, as we roll into this new year, into 2025, how do you see that AI trend evolving from here, Ben?
Yeah, so I think there's going to be continued momentum in the what we'll just call infrastructure play. So that's the networking stocks, Broadcom, Marvell, and obviously NVIDIA remains super well positioned going into 2025. I think everybody's confirming a whole host of demand for continued GPU growth for them. And then obviously everybody else that's in that cycle, right? So AMD as well, Intel, there's still going to be a bunch of compute. And a lot of this is just predicated on the fact that most hyperscalers are in the process of not just adding new square footage of servers, but retrofitting a whole host of their data center over from general purpose servers to AI servers. And there's only, very small percent, 10%-ish in 2025 got converted. So a ton of growth still going on the infrastructure side. So I imagine that will continue. We're going to continue to see a tremendous amount of demand for compute. That's not going away. But I think what I'm looking for in 2025 is the software monetization of those stocks. And even if you just look at the examples that I shared, had NVIDIA, which was up, well over 100% in the year. You had Broadcom and Marvell almost up 100%, but yet you had, Google, you had Microsoft still in the mid double digits. And so I think looking to what software is going to play into 2025, as we expect a whole host of companies now to start deploying this AI into their enterprises at scale across 10, 20, 30, 40, 50,000 employees, we should start to see some of the software side of that. And I think that's one of the big conversations coming to this year is, will we start to see now not just the hardware infrastructure revenues play in, but the software side of this come in as well for places like SAP, Salesforce, and then the hyperscalers, Google, Microsoft, and Amazon.
And then, as these CTOs and CIOs were rolling out sort of these new AI features and functions, Ben, was it to improve efficiency where in organizations? Was it customer service, software development? Where did we see it?
Yeah, I think it was across the board. There was a host of projects that are being deployed. I think most surveys from CIO, CTO surveys I saw had well over 90% of CIOs and CTOs saying that they were in some form of a project or pilot deployment of AI. And that was everything from help desk to IT to software and engineering, so doing their own, right? So coding, engineering, accounting, marketing. And I think what they'll look for is, where did they see the most return on that investment in terms of the spend to the productivity increase. And we were hearing numbers anywhere from 20% to 60% productivity gains across employees in those pilots. So I think there's a lot of optimism there. Again, that's a small controlled group who's using that for those hosts of business functions that I talked about, but they're going to use some of that lower hanging fruit for efficiencies. Call center is one of the things we hear get brought up almost immediately across every organization, IT help desk and help desk as well. Those are the areas we think will start first, and then you'll see some of those engineering functions and marketing follow along with that. It won't be across the entire enterprise. It will be these very few very specific pockets of business functions where they think the lowest hanging fruit is, and then the rest of those rollouts will continue into 2026 and beyond.
Have you seen any indication, Ben, yet that those hyperscalers, those big cloud giants, have slowed down their spending to build out AI?
Not at all. And I think, there's a really good debate to be had. And part of this is a technical conversation as what happens when we move from training to inference. Last year in 2024, a lot of this was built on just training these large foundational models, continue to scale them, make them bigger, make them multimodal. Eventually, these will ingest audio and they'll ingest video. But there's only a handful of people really investing in training those foundational models. And I think the second side of this is going to be, what happens when this moves to inference? And does inference require more compute? And I think you would hear NVIDIA and others argue that it would. But would it require more compute to deploy at scale? Because now you don't just have whatever we have today, right? Millions upon millions of people using AI on a daily basis. When you get to hundreds of millions of people using AI on a daily basis, that again just drastically increases your compute needs from an inference standpoint. And so I think that's going to be one of the most interesting things to watch this year from a technical standpoint, which is both a hardware point and a software point, which is what happens when we move largely to more inferencing models, and how does that change the needle in costs and infrastructure needs and all of those things that we're looking at for just running AI in the background.
Let's move to the edge here, Ben. AI-enabled smartphones, like what Apple now offers, AI-enabled PCs. What do you expect to see in those markets in 2025?
Yeah, I think this year, right, end of this year, sort of started off the cycle of getting people more aware of what can be done with AI at a consumer level. And I think there's two parts of this, right? If we believe that AI will move out and scale in core business functions, so across the enterprise, there's going to be an edge component of that. There's going to be things that corporation wants to run at the edge to keep out of either public domain or to keep in a more secure and private situation for their data sovereignty. And that's where these AI PCs and AI smartphones start to play a role. And so that's a commercial function of this. And then obviously there's a consumer function of this as well. As you see, Apple doing with Apple Intelligence and Google doing with Gemini and some of the things that they'll put into Android that just increase the functionality, the usability, the software development story of bringing AI to apps at the edge. I think that's going to be a story we'll see more roll out in 2025. I think the enterprise story is still the most interesting one. It's the one we know corporations will pay for. So there's dollars there. We don't know if consumers will pay more for AI software at the edge, but we know that those devices need to be capable. So obviously what Apple's doing, what Qualcomm's doing in smartphones, those will be important continued developments so that we can compute more AI at the edge as well.
Ben, always great to see you and get your insight. Thanks for joining us.
Yep, thanks for having me, Josh.
Well, Tesla moving after reporting fourth quarter deliveries and the surging U.S. dollar. Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Josh.
Hey Josh, yeah, after a quiet few weeks in markets with not a lot of news, we finally got some stuff to talk about. So I want to start with Tesla. Tesla fourth quarter deliveries missing estimates this morning. So Tesla's deliveries coming in at 495,000 for the fourth quarter, below the 510 that Wall Street had hoped for, Josh. Interesting too that they actually declined on an annual basis for I believe the first time ever, or at least the first time in the last 10 years that we've been tracking this metric, Tesla for the total year 2024. Stock took a decent little hit on this. Stock was down about 6%. What I think is interesting too, Josh, when you start to zoom out, remember we've been talking about that post-election rally. Look at Tesla over the last 10 days now, down almost 21%. So people have been dumping this stock not only to end 2024, there was perhaps some speculation we had on the show earlier this week of maybe it's some profit taking, right, for the end of the year. Maybe there's some tax loss playing going on with some of these different names. But now we get to the fundamental story of Tesla, and the fundamental story today wasn't something that investors really loved.
Yeah, it was interesting. So Q4 deliveries disappoint, annual sales drop. If you saw what bulls were kind of saying today, I saw Dan Ives over at Wedbush telling his clients, he looked over the numbers and said, listen, he actually bets deliveries are going to accelerate next year. And in part, obviously, a lot of attention focused now on that lower priced EV, the expectation that comes mid-2025. And of course, Musk always says, right, if you own Tesla, it's because you're actually as excited as he is about robo-taxis.
Right.
That's why
you're excited about what this rally was, which didn't have a ton to do with Tesla selling electric vehicles, right?
No.
It started after the election. It has to do with Elon Musk's relationship with President-elect Donald Trump. It has to do with the potential for more autonomy in driving, right?
That somehow Trump will kind of accelerate or fast track all that.
And it's sort of a little bit more of the tomorrow story, not the story of fourth quarter deliveries. That is not something that a lot of Tesla investors talk about. It's what matters to the business, of course, but that's not what drove the stock recently over $400 a share, I wouldn't say. Final thing I want to hit on today, Josh, the US dollar is absolutely ripping. So we were watching this today because the US dollar hit its highest level since November of 2022. Interesting to see this move in the dollar that's really been taking place for a little while now. And one thing I'll highlight with this, Josh, when we get over to the dollar index, when you zoom out, so I know one thing you and I were talking about earlier is, okay, dollar's been tracking higher. What's the story here? Well, if you zoom out, I'm no technical strategist, but I did look at what some technical strategists were saying about the dollar, right? You're kind of breaking a 2-year trend here. You're starting to break forward. So the question would be, could the dollar continue to move higher? Some technical strategists are arguing yes. At some point, equity strategists would tell you this could become a headwind for U.S. stocks because for U.S. stocks, specifically companies that are related to international markets, right?
That's what
Companies
probably
that
a
sell-
lot of viewers see that and they say, okay, potentially it's bad news for multinationals.
Multinationals, Josh, and what's interesting, I was looking at this data from FactSet. This is the S&P 500 earnings growth for the third quarter, of course, the most recent quarter that we have data from, right? Take a look at this. Companies with less than 50% of revenue in the U.S. were the leading driver of S&P 500 earnings, right? So again, if we're going to talk about FX headwinds coming into play here, strong dollar being something that companies talk about on earnings calls and say, our earnings were a little bit weaker this quarter because of the strong dollar. Well, the companies that have been driving S&P 500 earnings, at least in recent quarters, are companies that are exposed to international. So I think that's going to be an interesting trend as we work through the first half of this year. Is FX headwinds one of the key things we're listening for on earnings calls?
Yeah, 10-year and the greenback, two potential
There you
challenges.
go.
Thank you, Josh. Coming up on this week's episode of the Yahoo Finance Sports Report, host Joe Pompliano chats with Yahoo Sports senior NFL reporter Jory Epstein about all things football as the league gears up for the playoffs. You can scan the QR code below to check out the latest episodes and be sure to tune in to the Yahoo Finance Sports Report. That's every Thursday at 5 p.m. Eastern. Here's a look at this week's episode.
For the Buffalo Bills, I mean, this is a team, and I know we're going to talk about this, that is building a new stadium. And so when I see, hey, they're building this stadium, $2.1 billion estimate. Oh, actually, it comes in $560 million over estimate. Well, maybe if you have a stake that you sell and it's about 10% and very similar cost. To me, what's so interesting is that the amount that they sold to private equity is very similar to the amount that their stadium budget came in over estimate. And so I'm not saying that is the number one reason or even maybe the primary reason that the Buffalo Bills were selling the stake to private equity. But I think we could be seeing this model where if teams are trying to get the funding for stadiums and they don't want to wait, rather than having a debt model, they could say, hey, or we can go get this money from private equity, maybe hurt our future revenue, but we don't have to hold up the progress on the stadium.
Well, as President-elect Donald Trump prepares to take office, Wall Street banks are leaving the Net Zero Banking Alliance. And the latest is Morgan Stanley. For more, we're bringing in Yahoo Finance's banking reporter, David Hollerith. David.
Hey, Josh. So Morgan Stanley said Thursday they're leaving this UN-backed international banking group known as the Net Zero Banking Alliance. And they're hardly the first major U.S. bank to do so in the past month. Citigroup and Bank of America both announced their plans to withdraw in recent days, and Goldman Sachs and Wells Fargo earlier in December. So the through line here is that all these big banks that are leaving the climate group haven't actually gone back on any of their own climate goals, but they're clearly much less enthusiastic about pushing for these carbon emission changes at a broader financial or to the broader financial world. Kind of the end goal of this group is to reach net zero emissions by 2050. And most of the big banks are still maintaining that. There's just a little bit less of a desire to have affiliation. And if anyone's speaking frankly, it does there is a factor at play here that has to do with the GOP coming into power. And that has a lot to do with the fact that there's been sort of attacks on what we would call woke investing, ESG-related investing by GOP lawmakers for several years. And the most recent happened in December, where the House Judiciary Committee, led by Ohio Republican Jim Jordan, actually spoke out about these climate alliances, calling them a climate cartel. So there is actually some legal risk to this, and it's been made by GOP lawmakers before, and sort of their criticism towards that. So that has something to do with why some of the banks are pulling out now. There are still over 100 European, Asian banks in this UN climate group, as well as JP Morgan Chase, though they did exit a similar group earlier in 2024.
All right, David, thank you so much. We're going to continue this conversation. Appreciate it. Sticking with climate and energy now, shares of Constellation Energy soaring as it secured a $1 billion deal with the government to provide nuclear power. Joining us now is Tony Parada, PA Consulting, Sustainability and Regenerative Economist, and Yahoo Finance's very own Julie Hyman. Tony, it's good to see you. So maybe, Tony, I'm interested to get your take there on what our colleague David Hollerith is reporting. These Wall Street banks, Tony, now beating a retreat, it sounds like, from this UN-backed banking climate group, just as Trump, of course, gets ready to move back into the White House. What do you make of that, Tony?
Well, overall, I think we're seeing similar issues happen across multiple industries where a large affiliation that becomes global in nature oftentimes becomes unwieldy. So in 2024, we saw the UN Plastic Treaty break down without a final resolution. They will reconvene next year. That is a symptom of these challenges being so systems-based and complex. I don't see it as a lack of commitment to these goals, as was mentioned earlier. It's more of a realization that there truly are complexities here, and oftentimes large affiliations make that difficult.
Well, and Tony, is it also a recognition of the sort of political climate? I've been really curious about what companies are saying publicly and what they're doing more privately. In other words, are they getting quieter about sustainability goals, but still trying to fulfill those goals, or some version of that? Is that what we're starting to see?
We have had this notion of what has been referred to as a green hushing, where companies are realizing, hey, even though I am making significant advancement against my goals, there may be benefits to me keeping that out of the media circle of light for now and continuing those efforts. In addition to that, there's been a lot of speculation about what will happen on January 20th and what's ahead. I actually believe that there will be a number of positive impacts and aspects as we move into a new administration. Let's remember that these challenges represent huge opportunities for the entrepreneurs and organizations that solve them and solve them conveniently and profitably. Reduced regulatory pressure should mean more innovation and investment in those sectors.
I'm curious, Tony, as a consultant, when you're talking to American CEOs and they're outlining their list of priorities right now, how high up are sustainability and broader environmental issues? I mean, is it as high up as it was a few years ago, or no, has it kind of taken a backseat to other priorities, like AI, for example?
We don't see it taking a backseat at all. It is still on every CEO and board's agenda. And in addition to that, there's a growing realization that the lack of a climate action plan is the lack of a business continuity plan. Not having a sustainability plan in place means your company will have a higher cost of capital. It means you're equally as likely of getting put out of business by climate change as you are by your competitors. Swiss Re recently came out and acknowledged that the cost of climate damage in 2024 alone hit $310 billion. So this is as much about financial futures as it is about our global and climate futures.
So then talk to us about sort of subtopic, subsector, where you're seeing the most energy being put forth. Is it climate risk mitigation? Is it, or as a subset of that, are we seeing things like carbon capture start to pick up steam again? You know, where is the energy and dollars flowing right now?
I think we'll see two significant trends, actually three. One, increased disclosures will come into play. So as a CEO, you should expect that your CFO and compliance departments will be engaged in more and more sustainability conversations. The second, we are seeing a reinvigoration of the carbon credit market. We've seen major moves by corporations here in the US at buying those carbon credits early and at very sizable scale. And then finally, we are looking at a notion of sort of active resilience moving forward. We know times ahead will be unstable. The days of sitting back and seeing what happens are gone. You need to take an active and dynamic role to ensure that you can be resilient in the face of what will be change from multiple avenues, including climate and sustainability.
Tony, I'm curious, what is the role that AI is already playing as you see it in sustainability practices?
Yeah, like almost any technology, we see huge benefits and some potential watchouts. AI obviously is one more example of us continuing to use ever more energy and increasing that appetite. These are enormously hungry applications that we use. But on the benefit side, we're beginning to see the ability to have machine learning and AI take the data that we're collecting and begin to have some positive outputs. One great example is we're taking, for the first time ever, data that we've collated from satellite imagery to understand where methane leaks around the world are coming from. Methane is 80 times more damaging than carbon dioxide, excuse me. So the ability of AI to both discover and assess those areas and then clearly identify them is a huge advantage. In addition to that, we're also seeing AI come into place with material recovery recycling. So the ability to look at what is coming through our material recovery facility, how do we separate and sort it at a way that's much faster than humans sitting on the line.
Tony, great to have you on the show today. Thank you so much for joining us.
Pleasure. Thanks again.
Stick around. We're asking for a trend right on the other side. The U.S. dollar is surging, but how long will the rally last? Yahoo Finance's Julie Hyman joins us now with a closer look with our chart of the day. Julie.
Yeah, the dollar's one of the topics du jour, right? You were talking about it with our Josh Schaefer a little bit earlier. This is a look coming to us via the Wall Street Journal of the dollar's value versus a basket of currencies, and then compare it with the 20-year rolling average. It is also, by the way, inflation adjusted. The big takeaway from this chart is that we have seen the dollar go up over really the past decade and again over the past year. In fact, according to the journal, it tracks the dollar specifically against a basket of 16 currencies, and it just had its best quarter via those currencies since 2016. Why have we been seeing this dollar strength? Well, even though the Federal Reserve has begun cutting rates, in general, we are still seeing the U.S. economy on stronger footing than many of its peers around the world. Certainly, if you look to places like Europe, so we have seen the dollar strengthen against the euro in particular, but we've also seen it strengthen against the likes of the Mexican peso and the Brazilian real. Again, because we are on different sort of tracks as to where we're going with interest rates, and the realization on the part of many investors, as well as the Federal Reserve itself, that maybe it's not going to be cutting rates as much as anticipated, has also helped buoy the U.S. dollar. As for what happens from here, it gets a little more complicated because on the one hand, some of those conditions I was just describing are expected to remain in place in terms of the U.S. economy continuing to grow, perhaps at a faster pace than some of its developed market peers, and the Federal Reserve leaving rates higher for longer. So that could potentially be supportive of the dollar. On the other hand, you hear some currency traders talking about reversion to the mean, in other words, because it's already been rallying for quite a while, and there's confusion over President-elect Trump's policies and what effect they could have on the dollar, just like we've been having these debates every day about the effect that they could have on the economy and on inflation from things like tariffs, from things like deportations. So too could it have an effect on the dollar. Further complicating that is Trump himself and his attitude towards the dollar. He has said in the past that he doesn't like a strong dollar because it makes U.S. goods less competitive around the globe. So what happens to the dollar going forward? You know, we don't quite know, Josh. So we're going to have to, like with so many things, potentially watch what happens in Washington.
We will. Thank you, Julie. And that is wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.